Hello and welcome to another YouTube tutorial video. This time around, we're going to address a good question that came in the other day relating to purchase accounting, purchase price allocation, and what to do when you have a non-controlling interest. So here's the question. Let's say that you had a scenario in which Company A acquires 70% of Company B. Company B has 30 shares outstanding at $40 per share with $1,500 in assets and $1,300 in liabilities. Can you walk through purchase price allocation in this scenario? So in other words, what happens when a buyer acquires not 100% of the seller, as is typically done in M&A deals, but 70%, or some other percentage that is less than 100%, but more than 50%? And then we also got this follow-up question from the same person on what happens if Company A already owns, say, 30% in Company B, and then Company A increases its stake from 30% to 70%. So these are all good questions, and I found that this particular scenario, acquisitions of less than 100% of companies, tends to cause a lot of confusion. So before we jump into Excel, I just want to lay out the rules for this so you know exactly what we're doing and what we're going to cover here. With purchase price allocation and combining companies' financial statements in an M&A scenario, there are really three cases. Case number one is when you acquire a stake of less than 50% in another company. And this is easy because there is no purchase price allocation, there is no financial statement consolidation, and there is no goodwill created at all. In this case, all you really do is create an equity investment or associate company to reflect this 50% or lower stake in the other company. So it's very simple. All that happens is a new asset gets created on the asset side of the balance sheet. Now, the second case is when you acquire more than 50% but less than 100%. And in this case, you do use purchase price allocation, you do consolidate the financial statements, you do create goodwill, and you also create a non-controlling interest. So if you acquire 80% of a company, the non-controlling interest represents the part that you do not control, the 20% that you do not own in that other company. If you acquire 70%, the non-controlling interest is for the value of the 30% that you do not own. And then the third scenario is when you acquire 100% of another company, in which case you still use purchase price allocation, you still consolidate the statements, you still create goodwill, but you have no non-controlling interest in this case because you control 100% of the entire other company. We've already covered scenarios number 1 and 3 in separate lessons and videos here, so this time around, we're going to focus on scenario number 2, these stakes of between 50% and 100%. It's not really that complicated, but it can be a little bit confusing, especially in cases where the stake goes from, say, 30% to 70%. A lot of textbooks and other sources don't really cover that, even if they tell you what to do when it goes from, say, 0% to 70%. So let's jump into Excel now and start out with the transaction assumptions for this deal at the top. We'll go through the sources and uses of funds and purchase price allocation, and then look at our balance sheet combination at the bottom. You can see the buyer and seller's balance sheets here lined up. So they're actually of a very similar size if you look at the total assets that both of them have, and then the total liabilities and equity, and so on and so forth. So where we start is with the transaction assumptions at the top. And we need to have an assumption for the existing stake that we have in the seller, and then how much we are actually going to acquire in this deal. So in this case, we're getting 40% on top of our existing 30% stake, so we'll end up owning 70% of the target by the time this ends. Now, if we only had, say, 20%, then we'd end up owning 60% in the target when this ends. So that is how it's set up. Here, we're going to be assuming that the seller is a public company, and so we have a share price for the seller, or at least a price at which we're buying the seller's shares, and then we have a total number of shares outstanding for the seller. With all this in place, we need to calculate a few numbers first before we can get into the rest of this exercise. First off, we need to see how much 100% of the seller or the target here is actually worth, because this is going to be used in a lot of calculations later on, such as the one for goodwill here at the bottom. To calculate this, we can just take the price paid per target share acquired, $40, just like in the question the reader submitted, and then multiply it by the 30 or 30 million shares outstanding for the target. So we know the target is worth $1.2 billion or $1,200 as it's listed here. And now the question is, what is the value of our existing stake in them? And then what is the value of the new stake that we're going to acquire in them? And what is our total ownership, our 70% that we're going to own in them at the end? What is that actually worth? So the value of the 30% stake is just equal to the existing stake that we own in the target times the value of 100% of the target. And then the value of the 40% stake that we acquire in this deal is just the 40% times the 1.2 billion here. And then at the end, we end up owning 840 million, which represents 70% of the seller's value. So we're going to end up using all these for different purposes in this analysis. But to start with, let's think about how much cash, stock, and debt are required to do this deal. Because just like with a normal M&A deal, when you acquire 70% of a company, or 40%, or 80%, you still need to use cash, stock, and debt to do it. That doesn't change even though we are acquiring less than 100% of the company. So for all of these, we're going to take the percent used and multiply by the equity value of the additional 40% that we're acquiring. I'm going to anchor that so it doesn't shift down as we copy it down. And so we have that set up. So we know how much cash, debt, and stock we're using to fund the deal. Let's move into the sources and uses schedule and the purchase price allocation schedule now. I have some notes over here on the side, as always. With the sources and uses and purchase price allocation schedule, these are largely the same as what you do with any other company or M&A deal. But the tricky part is that the sources and uses has to be based on the stake acquired, not 100% of the seller's value, but the goodwill and purchase price allocation should be based on 100% of the seller's value. So it's a little bit counterintuitive how you set it up, and this is one of the trickier parts of this kind of setup in this model. With sources and uses, let's just take a look at how much it's going to cost us to acquire the additional 40%. So we know the purchase equity value of that additional 40% is just 480 million right here. And then we're going to have some fees associated with this. We might have other fees, but I've just simplified it and assumed only capitalized financing fees, which will be based on the fee issuance percentage times the amount of debt used, the 160 million right here. So we can just take our debt issuance fee percentage and multiply by 160. We can add those up. And then on the sources side, we can just take our cash, debt, and stock first off, and then excess cash used, we're just assuming that any fees that we have are going to be covered by one of the company's existing cash balances. So we'll just take our total uses, subtract our sources so far, and the excess cash used here will be our plug. So we have this, and our sources side equals our uses side. Now in the purchase price allocation, the tricky part here is that you're going to base the goodwill created on the equity value of 100% of the target company. So it doesn't matter whether you own 30% and you go to 70%. It doesn't matter whether you go from 0% to 70%. As long as you go from owning under 50% to over 50% of the target, you're always going to base the goodwill calculation on the value of 100% of the target company. So this is very important, and this is a point that a lot of people mess up or otherwise get incorrect. The reason why you do this is because whenever you go from under 50% to over 50%, you consolidate the financial statements 100%, and so it makes sense to base the value of goodwill also on 100% of the seller's value. Those are just accounting rules and how it's set up, and that's what we're following here. So the equity value of 100% of the target is just a 1.2 billion up here. As always, we're going to subtract out the seller's book value. We can go down and just take their shareholders' equity right here. Just like in a normal M&A deal, this just gets wiped out. So negative 777. And then just like in a normal M&A deal, if the seller has existing goodwill, we want to write that off in this deal. So we have the 1.8 million there, and we can add those up. So we have about 424 million to allocate. I've already made some calculations over here for the write-ups just because it's not the main focus in this lesson, so I'm not going to go into it here. But we have write-ups of PP&E and intangibles, again, just like you would in a normal M&A deal. And then we're going to write off the seller's existing deferred tax liability down here. And then we're going to create a new deferred tax liability. We're skipping over the rationale for this because it's just not the focus of this lesson. But long story short is that purchase price allocation itself is very similar. The only difference is that regardless of the percent stake acquired, you always start with the value of 100% of the target and base it on that. So we have our goodwill. With that all set up, we can now move to our balance sheet combination. Now, this is largely the same as what you do for any other type of M&A deal. And again, I have a list of the exact changes over here. So we're going to adjust cash for the amount of cash used to fund the deal. We're going to write up the assets just like you would in a normal M&A deal. We're going to reflect new debt issued and possibly debt refinanced, although that's less likely for under a 100% stake in a company. We'll adjust the deferred tax liabilities, and then we will adjust the shareholders' equity value by wiping out the seller's existing value and then adding the value of any stock issued right there. So the only real differences here are that if we already own, say, 30% of the company or 20% of the company, that asset is going to get wiped out in this deal. And then if we end up owning less than 100% of the company, we need to create a non-controlling interest to handle that scenario. So let's go through these adjustments line by line and see exactly what happens here. For cash and cash equivalents, we can go up to the sources and uses schedule and get this. So we'll take our cash used and then our excess cash used to cover the fees. And so our cash balance ends up being lower than both companies added together. For PP&E, we have to factor in our write-up amount right here. And the same for other intangibles. So we'll just factor in our write-up. Capitalized financing fees, will add in our fees from the schedule above. So we have those. Now, for goodwill, you have to be careful because here we're doing two things. We're writing off the seller's existing goodwill, and then we're also creating new goodwill. So the new goodwill we create, again, is based on 100% of the other company's value minus their book value, and then you factor in the other adjustments. Here we end up with the $366.5 million of goodwill created, and then we're going to subtract out the $1.8 million of existing goodwill that goes away in this deal. So far, all of this is exactly the same. The one difference that comes up here is with the equity investment line item. So here, this $360 million, if you look at it, I'm just linking to the existing stake in the target times the purchase equity value of 100% of the target. So this just represents the 30% that the buyer currently owns in the seller. The problem is that once they acquire over 50%, or they end up owning over 50%, this goes away completely. So what we have to do here is actually get rid of this. And so what we can do is just flip the signs and turn this into a negative, and this will go to zero because now we are consolidating the financial statements 100%, and so we no longer need this item. Now, if we didn't already own 30% in this company, this would just be zero. So let's say I went up and I changed this, and let's say, for example, I made the existing stake 0% and I made it so that we're acquiring 70% here. Well, in this case, the equity investment would be zero to start with, and it would not change at all. It would just simply stay at zero. But I wanted to show you what would happen if we have a slightly trickier scenario with a 30% initial stake. So that's the asset side. Now on the liabilities and equity side, we have to reflect the value of new debt issued as always. So let's go up to the sources and uses schedule and link to that. The deferred tax liability, again, we're doing a couple things here. We need to get rid of the existing deferred tax liability. And then we also need to reflect the new deferred tax liability that gets created. So we have that. Those are the only changes to the liabilities. Then for the shareholders' equity, so as always, we need to write off the seller's existing shareholders' equity. And to do that, we could just go up and link to our purchase price allocation schedule. So this goes away completely. And then if we have used stock to fund the deal, it's going to show up within shareholders' equity and boost that line item. So let's go up and link to our stock issued right here. And so we have that. And then the last thing we need to do is figure out what to do with the non-controlling interest here. If you think about this mathematically, the non-controlling interest represents the portion of the company that we do not own when all is said and done here. So in this case, we end up owning 70%, which means we do not own 30%. So to calculate this number, we just take the value of 100% of the target, and then we subtract however much we actually end up owning after the deal takes place. So it's just 1.2 billion minus the 840 million right here. And it's just 360, and now we can see that our balance sheet balances. So if you think about the way this actually works, what's really going on here is that because of the way that we've allocated goodwill here, this only works if we actually create a non-controlling interest on the other side of the balance sheet, because this ensures that even though we're allocating goodwill based on 100% of the company's value, if you think about all the other changes here, the cash, for example, and then the debt that's issued and the stock that's issued, these are all based on an additional 40% stake, so that eventually we get to around a 70% stake in the company. This non-controlling interest adds in that extra 30%. And so when you factor in this, and then the stock, the debt, and the cash, the non-controlling interest ensures that everything balances and that the amount of goodwill created, which represents 100% of the company, matches up properly. So that is how we go through the purchase price allocation process for this particular scenario. Now, I do want to show you a few other cases here of what happens. For the case where we start with a 0% stake and then go to a 70% stake, this is actually even easier, because all that happens here is that we have a 0% stake and then we go to 70%. And so in this case, we still allocate goodwill based on the value of 100% of the company. So that doesn't change. The goodwill created stays the same. What does change is that we are using more cash, debt, and stock to fund the deal. We don't have any equity investments to get rid of, so nothing happens there. And then going down to the bottom, we still create exactly the same non-controlling interest because we still do not own 30% of the company. Now, if we had another scenario, so let's say we went from a 30% stake to a 100% stake, what would be different here? Let's start at 30%, and then let's say that we acquire an additional 70%. In this case, once again, the goodwill created stays the same. Why? Because it's always based on the value of 100% of the target. So what ends up happening here is that, again, our cash used is going to be somewhat different. Our equity investment goes away because this is no longer necessary when we own 100% of the company. And then our debt used and stock used, of course, are different. And we don't have a non-controlling interest anymore. Why? Because we now own 100% of the company, and there is no part of the company that we do not control. We control everything, so a non-controlling interest here doesn't really make sense. And then the other scenario is, what if we go from a 0% stake to a 100% stake? Well, this is very easy because it's really just a normal M&A deal then. So if we set this to 0% and then make it a 100% additional stake, again, goodwill is exactly the same because it's always based on the value of 100% of the target. Now, the amount of cash, debt, and stock that get used will be different here because we go from 0% to 100%, but goodwill stays the same. We have no equity investment because we don't own anything to begin with, and we have no non-controlling interest. So it's really just like a normal purchase price allocation process in this case. If you wanted to go back in and you wanted to play around with other things here, so let's say, for example, that you wanted to change the amount of cash, debt, and stock that you used. So say 50% cash and 50% debt and no stock. Everything is pretty much the same. We still create the same amount of goodwill. The amount of cash, debt, and stock that you used are different, but the goodwill stays the same. The treatment of the equity investment also stays the same. And then if you go down further, the treatment of the non-controlling interest stays the same. So this business with non-controlling interests and equity investments does not change regardless of the purchase method, regardless of the amount of cash, debt, and stock used to pay for the company. And you can play around with other scenarios and see what happens here, but that is just one quick thing I wanted to show you. To summarize everything we've done here and how these rules work. When you acquire less than 50%, there is no purchase price allocation. There's no financial statement consolidation and no goodwill. When you acquire over 50% but less than 100%, you do use purchase price allocation, you consolidate the statements 100%, you do create goodwill based on 100% of the company's value, and you create a non-controlling interest for the portion that you do not own. And that is how you get everything to balance. And then when you acquire 100%, you also use purchase price allocation, you consolidate the statements 100%, you create goodwill, but there is no non-controlling interest here because you control 100% of the company. With the cases that we went through, if you go from 0% to 100%, it really is the same as a 100% acquisition, but you need a non-controlling interest for the other 30%. So you need to create that to ensure the balance sheet balances. For a 30% to 70% deal, it's the same. You need a non-controlling interest for that portion you don't own, and you need to remove the existing equity investment because this is no longer necessary when you own a majority of the company. 30% to 100%, here no non-controlling interest is necessary, but you do need to remove the existing equity investment from what you had initially because you don't need it when you own 100%. And then 0% to 100%, this is just a normal M&A deal. You use purchase price allocation, but there is no non-controlling interest and no existing equity investment to remove. So that's a little bit about how the process works when you acquire some number other than 100% of another company. You should now have a better idea of how to do this and why certain items, such as the amount of goodwill created, do not differ regardless of the exact stake acquired as long as you end up owning over 50% of the other company.